Hey, everybody. Welcome to the Wealthpress Mondays Roundtable. I'm here with Roger Scott. Roger, welcome.
Thank you, James. Thank you very much for having me. How are you and how was your weekend?
I had a great weekend. Actually, it was replete with work, which is just how I like it.
That's that's good. That you know what? That's how I like it too. I get tired. I take Saturdays off, and then by the time Sunday comes, I'm like, I'm done with this. I'm going back to work. I get my charts, and
Sure.
so yeah,
Uh,
I want to know what the market's doing.
yeah, well, let's jump right into that. I mean, we're looking at the S&P at this point is up 1%. Dow Jones is up 0.32%. It looks like a pretty mild open, but it's not radically to the downside, radically to the upside. What do you think is driving market sentiment today?
To be honest with you, I think the market is looking for directional bias right now. I think the market is still trying to find some certainty in where we're at right now, and I think it's very hard to do that because we honestly don't know where we are. It's a moving target. We heard this morning from one of Donald Trump's head medical liaisons. She was talking about realistically 100 to 200 Americans dying from this, which is completely out of line with what we're seeing right now, which leads me to believe that they believe that this coronavirus is not going away anytime soon. And if that's the case, then I think the market is going to have a lot more discovery to do before it finds its groove. And that means more volatility and unfortunately more downside. I don't think we're done yet. I'd love to tell you we are, but it doesn't feel that way at all. And based on everything I'm seeing, it doesn't look like the market could figure out its true value for quite some time.
Sure. So, with I mean, everywhere in the world, it seems that the periods of everything from total lockdown to social distancing are being extended, demonstrating that the collective sort of expectation is that we're still rising into this pandemic, and we
Right.
haven't peaked by any stretch of the imagination. And the epicenter, just in sheer numbers terms, has now moved to the United States. And there's no denying that the United States had a delayed response in taking the virus seriously, which has probably caused it to be a little bit more at risk, I would think, than the rest of the world. And as the economic sort of engine and bellwether of the world, that has serious repercussions for stocks, for every form of debt instrument, whether it's government treasury debt or corporate debt. I mean, the bailout packages that have come rolling out of the Fed basically cover every corner of the market except for actually buying equities directly out of the stock market, though they've created these or reinitiated some of these special purpose vehicles that are kind of off the Fed's balance sheet that we can't really see what's going on because they've
Right.
suspended the reporting on those as well, the sunshine reporting. So, I mean, in terms of the individual investor, I mean, where do we look for, where are you seeing opportunity in all of this negativity?
Well, that's a great question. I'm actually looking ahead and I'm trying to see what I always do. And this is just the way my mind thinks. Hey, Lance, how are you?
Hey,
Welcome.
Roger. Hey, James.
Hi, Lance. How are you doing?
Good, good. How are you, gentlemen?
We're
Good,
all
good,
right.
good. Thanks for being here. And we'll get into your analysis in a minute too. You're not excused from this.
And not off the hook.
Not off the hook, not even close. So, but it's good to see you. I haven't talked to you in a while. It's good. It's going to be good to get your now. I'm looking forward to hearing what you have to say. But this is what I'm looking at, James. I'm thinking right now. This is where my mind is going, and what I'm thinking to myself is, okay, how is this going to shake out? It may take another month. It may take two. It may take three. But how is it all going to shake out? Who's going to be damaged? Who's coming out of this ahead? And I've got two working theories. So one company, and so I believe China, regardless of how truthful they are right now, I think they're going to come out of this ahead because they started all of this. So they're naturally going to come out of this epidemic or pandemic. They're going to be the first to recover. And there's this one company, and it's actually doing really well on the chart on the relative strength S&P. It's called JD. And what they are is it's an e-commerce platform very similar to Alibaba. And the only not the only difference, the major difference between Alibaba and JD is they have their own infrastructure and they have their own logistics. They have everything, they own it themselves. And right now with the pandemic, obviously subcontracting, all this is going to get very, very difficult. So I believe this company is now going to come to the forefront, and it's going to give a lot of companies. It's the only company in China that signed with Walmart to deliver food to rural neighborhoods. So they're really thinking ahead, and I'm thinking ahead. I'm thinking like, how are things? I'm not thinking tomorrow. I'm thinking 3 months from now, 4 months from now. How are things going to? How are we going to recover from this? Who's going to benefit? Who's going to have the shovels? When gold is hot, who's selling the shovels? That's how I'm kind of looking at this. So that's number one. And the other, you're going to like this. We're going to have a lot. I think everybody here agrees that retail is going to. It's been trending down for many, many years. Amazon's been picking up market cap. But if you look at large cap department stores like Macy's, they've been circling the drain for years now. So I think a lot of the department stores that have been on that vulnerable part of the wagon, I think they're going to get finally kicked, and they're going to go through bankruptcies, and somebody's going to have to liquidate them. Someone's going to have to auction them off. Someone's going to have to clean up the mess behind these large department stores. There's a lot of moving pieces. Who does that? Well, there's a company called Riley, B. Riley. Ticker symbol RILY. And they have 6 divisions, and each of these divisions deals with a certain part of this process, of this winding down process, if you will. And boy, oh boy, I'm going to tell you guys, there's going to be a lot of winding down when this is over. Whether you like it or not, it's just going to be part of it. We're going to see brick and mortar stores go down. So those are my 2 stocks. I think China's going to be picking up the pieces fastest. And I think we're going to see a lot of turmoil in the retail brick and mortar space. So I'm looking at 2 companies that are looking to profit and are looking for massive opportunity in light of what's going to happen down the road.
Mm-hmm. All right, Roger, that's intriguing. We'll have to have a look at that. Now, Lance, tell us about what you're seeing. Where's the opportunity in the calamity we're witnessing here?
Yeah, Roger must have been reading my mind the past week. So there's actually 2 points I want to make. We'll get to retail in a minute because I'm a huge retail stock trader, retail trader too now. But I love trading retail. In my opinion, you have so many opportunities trading retail, from earnings, same store sales, so much news catalyst events. And like Roger said, the big department stores are just getting hammered right now. But Roger brought up a really good point on JD.com, the China e-commerce name right there, because JD has really over the past few months has been very, very strong despite the overall weakness, especially if you look at U.S. stocks and then China stocks too. JD has been, from a charting perspective, holding up very, very well. So there's also another name based out of China that I like, and it's Billy, BILI. They're a mobile device, kind of like a Zynga that we have here in the U.S., the Zynga that makes the mobile games you play on your iPhone. Billy, it's holding up really well on the charts, just like JD.com. And we're actually seeing some nice institutional flow, some recent 13F filings with some funds taking a position in the name. I like that name. As Roger was talking about China, which will start to get out of this mess quicker than these other countries. Everyone talks about Alibaba, but look at BILI right there. And then going to the retail point, I actually like 2 retail stocks, and there's really, they're not like hidden gems or anything. They're Lululemon, LULU, and then Nike. Nike just had an insider buy. I think it was the first open market buy. I think it was only about 200,000 worth of stock. Obviously, that's not huge for Nike. But having an insider in the company going in the open market buying stock, that's a pretty bullish signal. And the big thing you have to look with retail is names that have shifted online, not your Dillards or your Macy's, or as we see with J.C. Penney's that are very dependent for mall traffic. Look at the names that have shifted their focus to online sales. So therefore, good, very easy to use website where people physically don't have to go in the store, and buy, let's say, some clothing at Gap or Banana Republic or Urban Outfitters. So Lulu's really taken a big online presence, and Nike is very, for buying shoes and clothing. Nike has really made their online very, very easy to use right now.
Lance, just to give you, since you mentioned inside buyings, the three big inside buyings the week before last week, Exxon, the CEO made buy for the first time since 2006, 35,000 shares, over $1 million. Wells Fargo was a really, really big one. And the one that really surprised me was IMAX, because there's been a lot of talk about BK, and their CFO stepped in and bought 5,000 shares. So I just wanted to bring that up because you started talking about insiders, but those were the three big insiders.
Yeah, we're seeing historically, we're seeing insider buying pick up on this recent market sell-off. So it is showing that management insiders are having confidence that this coronavirus will pass and these stocks will rebound. Obviously, we don't know if it's going to be the next 3 weeks, next 3 months, or next 3 years. Usually I look at insider buying as more of a long-term, point of view. But I will say, especially with Chevron, the stock had a very positive reaction after that insider buy. I think it was up about 6% the following day or so.
Right.
So that, they're bullish signals, and they should increase investor confidence going forward, in my opinion. I do like seeing this, because as we were making new highs in the U.S. market, we were seeing historically high insider selling. So it is good seeing, stocks that have declined 30, 40%, management coming up, buying their shares of stock.
I also think that's a very strong and a very positive sign, because, they may not know where the market's going to do. They may not know coronavirus, but they know their company better than anyone. And to put good money behind good money is a very, very strong indicator. It always has been in any business.
Let me ask you guys. Being the perpetual skeptic here, to what extent do you think that insider buying is sort of a tactic at this point to sort of intentionally paint the tape, if you will, to demonstrate a level of conviction on the part of management that isn't necessarily legitimate? It's more or less an intentional perception management exercise on the part of management to stem the hemorrhaging. And I'm not, obviously, when an insider steps in and buys 5,000 shares of the stock trading in hundreds of dollars, it's not a light commitment. But I'm just curious, from where you sit, to what extent do you think that is a factor?
Well, to give you that's a good question. And what I like to do is I like to look at the history of the buying. And sometimes you'll see a company step in right when the market during downturns, which is why I mentioned the Exxon. See, the Exxon was very unusual because the last time he bought was actually in 2006, not 2008. So I thought that and he hasn't bought since. The first time this guy's bought in 14 years. So the share size was just humongous, 35,000 shares. So I understand what you're saying, and there is some of that. There's no question about it. But in these cases, I looked for the companies and I looked for the history, and I did not see that type. I think every company is unique, and some companies may do that and some may not. And if I see a company doing very active buying or looking for opportunities, and I'll look at I'll put up a chart and I'll look at to see when the stock was down, to see a few previous times, and sometimes it'll match up perfectly. But none of these cases did that. These were completely wild, random, very rare buys by very key personnel in the company.
Mm-hmm.
So I hear what you're saying, and it is an issue, but I don't think it's an issue in these particular cases because I just did not see this type of activity previous to this, or any type of opportunistic buying, to put in other words.
Okay.
And Roger makes a good point, because you do have some companies, and I don't want to call them bad players or you're bad actors in a sense, but a name like GE, where they would publicly go out on the financial media and say, well, director A or manager A bought X amount of shares. He bought 4 million worth of stock at 17. Then the stock goes to 15. Oh, he bought 2 million worth of stock. The stock goes all the way down to, $8-9. Obviously, that's cut in half, right? So those aren't what I would consider good insider buys, especially if they happen frequently. You have to figure, let's say $3 or $4 million to a director of GE is not a lot of capital, right? So they can try to go in the market and say, well, we're confident in the business, we're gonna buy our stock. You really have to look at the history and see if they do that every few months or something like that. And signals like that I don't like to take, and I don't like to put much focus on, or especially if it's like a apparel or retail company, like one they just had was GII. It's a apparel company. You had insider buying at 26, at 25. Now the stock's at 7, and they're buying more stock here around 7. Obviously, I don't want to take that signal if he's buying it at 26, and the stock's getting cut like that. So you really have to look at the size of the purchase and then how frequent they do it.
Their pattern of behavior. I think that's the key word. Their pattern of behavior. And like this Exxon, I loved it because the guy hasn't done anything since 2006. Same thing with Wells Fargo. It's when you see very isolated incidences, it just clearly looks like it's done in good faith.
Mm-hmm. Okay. Are other guys following the commodities? One of the main opportunities that I'm seeing here is in palladium, which has rebounded dramatically from it was as high as $2,800 per ounce back in early March, dropped as low as $1,400 per ounce on March 17th, and then rebounded to 2283, is backed off slightly today at 2150, but still just a remarkable whipsaw in the price of palladium futures. And that is reflected to a lesser extent in gold. And while a lot of these stocks are performing extremely well and ricocheting back and forth, trading like microcaps, I think was the theme I heard discussed broadly across a few channels last week, is when the large caps start trading like microcaps, people start to get very nervous. And certainly with all of the bailouts underway, the search for safe haven assets has sort of intensified, especially with the 3-month T-bill now trading at a negative. And so I think you can see that in both in actually the whole precious metals complex, not just palladium. Palladium has the widest range of volatility, from $1,400 to $2,800 in the space of 30 days. Just incredible. If you happen to get in there, I mean, there's life-changing gains to be had right there. But we're starting to see that money come back to gold and silver, as well as the world's safe haven investors start to shun all US dollar denominated assets due to the implications inherent in trillions and trillions of dollars worth of bailouts. I mean, it's just unprecedented. And the implications for the buying power of the US dollar are just phenomenal. And that's why, I'm following. I'd like to say I jumped in that early and rode that wave. I didn't. However, I am looking for that kind of volatility as we start to see this huge stimulus start to impact asset prices, as the U.S. essentially puts a floor on the entire stock market and bond market. Do you think
that the the commodity that you're talking about, do you think it's seeing a lot of spillover from the gold market? What is the primary catalyst? That's what my question to you right now is for it.
Well, the primary catalyst is the global stimulus effort. And so when when you see the ECB, the Chinese central bank, I mean, it's interesting. You're getting conflicting signals. People are, ECB and China's central bank are saying we're not going to rush to stimulate our way out of this, and that's contradictory with what's actually happened. I mean, the U.S., the Fed is actually buying mortgage agency mortgage-backed securities now at the rate of $560 billion per day, which is just unfathomable. And so I think that the disconnect between what is being broadcast by the central banks versus what they're actually doing is creating a great deal of nervousness among the largest capital pools in the world, who typically, the largest capital pools always have the greatest level of capital preservation versus risk appetite. And so when you see them abandon US dollar and, even more importantly, German denominated debt and UK gilts, and when they start to look at those and prefer gold and actual hard assets, that really has got to give you pause and think that, geez, this is all changing. And I think, again, what are they following? They're looking at what the actions of the central banks are and saying, it's time for us to rebalance our portfolios to get more exposure to gold and less exposure to to G7 currencies, which is disturbing to say the least.
Do you think the correlation between gold and other precious metals is going to continue for some time because of this?
Yes, and no. I mean, if you were to sort of put gold and silver side by side, gold takes off and silver sort of sits there in a stunned deer in headlights mode for a couple of sessions before it started to catch on, because people are always, they react to what they know best. And everybody knows the gold story, at least in some way, shape, or form, whereas people are less familiar with the silver story. But as soon as the gold price takes off, then the sort of the content blogosphere starts to pick up the stories about, well, hey, you think gold is the opportunity? You look at silver, it hasn't even caught up to gold. And so everybody rushes into silver because it has that awesome price point that creates the impression that you're getting more for less money, which is just a fundamental characteristic of the lesser financially literate set, who tend to gravitate towards that concept. That's why companies price shares at lower prices. People don't think that, well, it doesn't matter what the price per unit is. It's the price of the whole, arguably, that you've got to look at, which is why, silver and gold are always trading in some form of lockstep. Now, typically what happens if gold experiences a prolonged period of interest, of renewed interest, such as that was what we're seeing now, then the ratio of gold to silver pricing comes down. So when we say gold to silver pricing, I'm talking about how many ounces of silver does it take to buy 1 ounce of gold. And in times when precious metals are out of favor, that ratio can widen out to sometimes 90 to 1, 80 to 1. But when gold and precious metals become much more in favor, exactly, they start to come closer together. And so that's really where you're getting a sort of a leveraged lift by buying silver, is because not only you're going to get the lift when the commodity price itself rises, but you're going to get the implied lift from its closer correlation to the gold price, which implies an inherent higher value for silver, if not an inherent higher price for silver. Price always takes a while to catch up to value in most situations, especially when it's an opaque market that's a little bit less popular than the usual stock market.
And then as they get closer and the volume increases, you're going to have the arbitragers trying to arbitrage the difference between the two, and all that fun stuff happens, which doesn't happen when they're wide apart as well. But it's very interesting. A lot of people don't understand that's what causes the correlation. I'm glad you've explained it. It's actually very interesting for a lot of people to understand that.
You bet. All right, guys, closing thoughts for the week.
Well, my opinion is I'm very, very curious to see how the Fed data, how the stock market is going to react, and how the global currency market is going to act in light of the federal data that's coming out this week. I'm looking at consumer confidence, and I'm looking at manufacturing reports, which are going to come out midweek. I want to see, because now they're starting to take into account much of the coronavirus, or at least the pertinent parts. So I want to see how the markets react and how the various sectors react. That's going to be very telling. Also, I believe this week, I think the reality, because up to last week, people were still in America, were still not taking this as seriously as some other parts of the world. But right now, I believe this is going to be the different week. This week is going to make all the difference. Why? Because it's hitting home. Beaches are now closing down. Famous people or celebrities are starting to get deeply infected. People are starting to relate to this on a personal level. I'm actually seeing people around me being more cautious about their space than they were a week ago, whereas a week ago they were looking at this and thinking, this is just an overreaction. So it's starting to sink in. It's starting to hit home for Americans. I think the grim projections the medical department gave today, 100 to 200,000 possibly dying. The numbers are really low right now. So when people are looking at that in comparison, it starts to drive the point home. So I want to see how the market, I want to see if the volatility index can regenerate itself to a higher fear level, or if the level of fear we have seen in the previous weeks was the highest. I think for me, that's going to be the biggest factor that I'm looking at this week.
All right. And Lance, where do you think the focus is going to be for you this week?
So we have earnings season starting to come out, and we've already had some names report earnings, a couple of retailers like Nike and Lululemon, Micron from the semiconductor space. They actually gave guidance, which was a little shocking. Historically, stocks tend to move on earnings. 4 times a year, it's usually a fantastic opportunity, especially from a trader and or investor to really make some money. I think earnings season this time around are going to be A, light, and then B, we're not going to have a lot of guidance and forward projections. So it seems the market is taking that into consideration, and they're really not selling off these stocks that aren't giving guidance. Which in the past, if a company cut guidance or didn't give guidance, you were having many red flags. So I actually think that's going to be kind of a pause, wait and see ordeal. If we're looking at market direction, I think stocks, I don't want to call this the bottom, but I think stocks go sideways for the short term, maybe the next 2 to 3 weeks. Obviously, I think we're going to have volatility continue where we see, the Dow move up 500-600 points up or down. The pajama traders have taken over, meaning the futures market and the overnight session has just been, insane. So I think, being very selective right now is key. Scaling down your size, trading small, and really just being patient. You don't have to go and put all your eggs in one basket and make these, large amounts of capital into either some commodity, some asset class, some stock right now. So just be nimble. And this is the first time we've seen something like this. So really nobody has a clear picture of what, is going to happen 2 to 3 weeks from now. But I think we're all hoping this passes and we can get back to normal, normal trading, normal investing, and then, just have our way of life, continue and go back to normal.
Just to add to what Lance says, volatility, just to give you guys some perspective, the volatility on the S&P 500 SPY, the ETF, was roughly $2, give or take, between $1.60 and $2.50. It went as high as $21 last week, and this is the 10-day average. And now it's about 15. So volatility went 10 times higher, and now it's 7 times higher. So for every 100 shares that you have, you should have traded last week 10 shares, and now about 15 shares, if you will. So That's what Lance is saying is very, very important. And I want to put some actual numbers on it. Volatility is not twice higher. It's 10 times higher, 8 times higher, 7 times higher. Keep that in mind. Being nimble right now is key.
And that's really, a sense of ego and emotion in trading too. If you're normally trading, let's say 100 lots of options, it from a emotional perspective saying, man, I'm only going to trade a 10 lot now, to us as human beings who have emotions, that's man, I'm only doing 10 contracts, and that can really hit people, especially, or even doing 50 lots from 100 lots. But don't, take your ego aside, take the emotions out of it. You can still make money. You could still position. If you want to buy long term, you could still scale in. If you're normally buying 1,000 shares, nothing wrong with buying 100. Maybe you buy 100 next week or a couple weeks later. Take your pride out of the situation. The market, it takes no prisoners. And again, it's about long term. It's not a sprint who could get rich the quickest. It's a long term game, and really, taking this step by step, day by day, I think is very important.
I want to thank everybody for joining us today for the Wealthpress Weekly Roundtable. If you'd like to learn more about Roger Scott or Lance Ippolito's incredibly valuable services, visit us at wealthpress.com and start your journey of financial independence there. We'll be back next week at about the same time. Thank you for joining us.